Hello and welcome to episode 296 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How you doing?
I'm good. It's been really good to be back because unbeknownst to listeners out there, you and I haven't actually recorded a podcast for probably 3 weeks. And we normally do this on a Friday, don't we? We try and do it earlier in the week, but we always end up doing it last thing on a Friday. And you guys out there get the podcast about 36 hours later, early hours of Sunday. Well, Andy and I, because Andy was away for a period, weren't you, Andy? Half term and everything, time off. We were like, not even ships in the night, were we? We didn't see each other. So we recorded our podcasts in a batch, which is very unusual, but very productive and efficient, wasn't it? So we haven't sat down and done a podcast for about 3 weeks together. So actually, it feels good. It's like a nice change. Well, it is like greeting back an old friend, Andy, given that we have known each other for 20 years. But on that, generally, I'm absolutely buzzing about the podcast last week where we interviewed Emma. And Emma told us about the story of her cancer diagnosis and the insurance policy she had and the impact it had on her life. And we received so much great feedback on that show, and particularly, which I think Emma really enjoyed, was the motivation to get people to check their insurance policies or to take out new insurance policies. It even spurred me to do that. So I think that for Emma, sharing her story, it was one of those things that was a real, I don't know, for her, it gave her a real positive, like the silver lining of a very dark cloud. So thank you to everybody who wrote in. I did forward on your comments to her anonymously via email, and she was really grateful, and so she's offered to come back in future as well to update us. So that was really great. Interestingly, talking about insurances and the benefits of them, I just want to lead on to something that made me laugh this week of Andy. I mean, it wasn't Andy balancing the chair on his chin during a Zoom call where we're doing our meeting. So if you want to see that, that's on our social media. It's on our Instagram, Twitter and Facebook, where Andy balanced a chair on his chin for the benefit of everybody else in the call. And Andy's a man of many talents. So equally, Andy wasn't just doing that on his Zoom calls this week. You had a slightly more, perhaps unusual Zoom call, didn't you, this week, Andy?
Yeah, I mean, talking of insurance, it's a slightly different insurance. It's a pet insurance policy. And obviously, we're experiencing lockdown at the moment, and it can be tricky sometimes if you have a pet that's potentially ill and needs treatment or certainly a consultation. I checked my pet insurance policy and realised that I could actually do a pet consultation via the mobile phone, effectively via a Zoom call. So my young pup, Lola, has developed a bit of a sneezing and coughing. She was having things coming out of her eyes and her nose. And I think it's just one of these things. She's in season. I wasn't that fussed about it, but I thought it would be really nice to speak to someone. Lo and behold, my pet policy has got this great service. And I booked in an appointment and spoke to a vet. I could see them in their practice. They could look at Lola and give her a diagnosis and recommended the things to look out for. And if obviously she needs treatment, the things we need to look out for in the future, and basically take her in if we need to. So a great thing about policies, these are things that we talk about in other areas of insurance where you've got these additional benefits that you don't necessarily know are there. I didn't really know it was there. I took advantage of it and it was brilliant. And actually, talking of pet insurance, it kind of inspired a piece on the podcast this week. So I'll be talking more about pet insurance later on and the benefits and what to look out for. I'm just about to ask you, Damien, what's going to come up on this week's pod. And actually, before we go on, Damien, I'm going to quickly read out a couple of bits of feedback that we've got on the podcast. We always like to read them out. If you can, remember, you can go to your podcast platform of choice and put in a review, and we'll read it out on the podcast when we receive them. So the first one is from Alex. I've never written a review before, but these guys deserve it. The podcast is current, relevant, and informative. Most podcasts I fast forward about 5 minutes because they ramble on, but not these guys. It's helped me focus on my savings, and I've built up an interest in my financial situation, which I think is hugely important. I look forward to listening each week. Keep doing what you're doing. So thanks, Alex, for that. And there's one other one I'm going to read out from Willie. I discovered these podcasts about 6 months ago, and since then, these two characters, Andy and Damien, have been my constant companions on my morning walk. This is hardly a podcast that doesn't contain a useful tip or trick. Damien's clear and simple explanations of complex specialised subjects has allowed me to gain a bit of knowledge where before I had none. I've generally found these podcasts to be useful, informative and entertaining. So thank you, Alex and Willie. And if you want your review to be read out on the podcast next week, make sure you go on and hit that review button and give us 5 stars as well.
Yeah, and before you move on quickly, Celeste, I'd say hello to her because she sent in a very nice email this week about how the MOT had transformed her finances at the beginning of the year. So all this stuff is great to hear because she was saying, please don't stop what you're doing. And it is very motivating for us to receive this. It isn't just about, it's nothing to do with ego. It's just that we know we're doing the right thing and it motivates us to carry on. So anyway, Andy, I'll now tell people what's on the podcast very quickly before we start. The first piece is going to be about investing in a COVID-free world. So we had the great news this week that there is a vaccine on the way for the coronavirus. So it literally turned the investment market on its head. And if you listen to Damien's Midweek Markets episode, which is episode 84, so you would have heard about this. But I want to talk about the usefulness of what happened this week for you in looking and reviewing your portfolio and maybe building a portfolio in the future. The second piece I want to do is another investing piece, actually, and it's about percentage returns and comparing them. It may seem very simple to some people, but actually based upon a question that I got from an 80/20 investor member within the forum that's within that service, there was obviously some difficulty people have comparing two different types of investment and their returns, making sure people compare apples with apples. I want to explain that. And finally, Andy, you and pet insurance.
Yeah, I'm just going to do a little bit of a dive into pet insurance, the things to look out for, is it worth it, and a few top tips, really. It's one of those things that it sounds easy, sounds simple, just get the cheapest, but that's not always the best thing to do. So I'm just going to give a few tips, really, for people who are considering it. So what are we going to start with this week?
Right, let's start with the investing for a vaccine-free world, the post-COVID world. Now, we had the news of this vaccine that should be coming along from Pfizer. And I mean, you'd have to have been in a cave not to hear about it. And there was the sense of euphoria that flooded the world about this vaccine. Now, obviously, we've got to caveat the whole thing that there are lots of hurdles for this vaccine. I think it's got to be stored at extremely cold temperatures, which does actually mean that it's more likely to be available to people in developed worlds rather than less developed countries, which there's a bit of morality in that. But the other thing is that there's still part of the clinical trial process that's got to be completed. But you've got to be optimistic, given that governments around the world, including our own one, are making press conferences about this vaccine and about how the NHS is going to roll this thing out. So they must be pretty confident that it's going to get through these hurdles and get past them. So if you listen to the Midweek Market show, you would have seen that the markets turned on their head, and it provides a really great stress test for your portfolio. So this is the crux of the piece on investments this week, is that look at what happened to your investment portfolio between the Friday, so the 6th of November, and the 10th of November, which was the Tuesday. The reason that you've got to do the 2 days is because if you've got a portfolio that's probably got unit trusts in them, they're priced once a day, so the movements in asset prices within funds can take a day or two to be reflected. So on the Monday, the market was going along nicely, just fairly flat. We were still in the euphoria after the US election. Tech stocks were flying, government bonds were doing well. The cyclical assets were doing okay as well, being lifted up, but still worried about the coronavirus. Then just like that, bang, the vaccine was announced and the market leapt 5%. And not all assets did. And this is what's interesting, is that some people will look at their portfolio over that 2-day window that I mentioned and will be sitting there thinking, what the hell happened there? I thought markets exploded higher. I looked at the headlines and my portfolio has actually fallen 1 or 2%, not leapt up 1 or 2%. And the reason is because there was a great rotation that happened. And the rotation, like I said before, when I've talked about rotations in equity markets, think of it like a swan swimming across a lake. So the swan is very serene and it looking very elegant as it goes across. There's very calm. The lake is very still and the swan is nicely moving across. That's the index. That's the S&P 500. They're the things that you're seeing going on, that ignoring the first spike higher in the day between Monday and Tuesday, markets were a little bit, not quite so violently upward, but they were definitely positive, but a little bit calmer. But you're looking at the indices at the moment and what you're seeing is that, yeah, things are settling maybe, but below the surface, the swan is frantically kicking its legs to get across the lake. And that's what's been happening in investment markets. We saw big rotations between asset classes. So we saw people dumping tech stocks, big style. We saw people buying cyclical stocks, So that might be financials, that might be things like airlines. I'm going to go through some numbers in a minute. And we had people moving money from the COVID world, so the work from home mentality, everything that worked well in the last 6 months, and moving it into the things that did badly, basically, planning for a world without COVID. And so you saw that violently happen. So anything that was value-based, so things that were unloved, that typically have cyclical investments, did very well. The things that were growth-orientated, so they have things like technology stocks or companies that are less exposed to the underlying economic conditions, they did poorly. So looking at your portfolio, this is a great stress test. So now if you want to go forward and you're thinking, well, everything I've held in my portfolio has now maybe dumped or fallen a bit unexpectedly. The week before, in the US election was around, it would have gone through the roof. I mean, my 50k portfolio did that on 80/20 Investor, but then things pulled back on the Monday because momentum turned on its head. It was one of the biggest switches we've ever seen. Yes, okay, if you look at it across a week, you've probably given back the gains post the US election. But what it's great for, you can build a stress test. So if you're thinking of building a portfolio and you're thinking this vaccine could roll out and the market is fundamentally changed now, maybe I'll look at how the fund did in that period between the 6th and the 10th of November 2020. That will give you a steer of how it will likely perform in a period where the vaccines rolled out widely. The things that underperformed are likely to be the things that will underperform in that environment. Of course, if the vaccine turns out to be a dud, then we'll see everything unravel. So first thing, check to see how your portfolio did, see what worked, what didn't. That will give you a sense of what probably is more value orientated versus growth. You will see certain asset classes like gilts did poorly. You will see certain asset classes like high yield bonds did particularly well. That's because they're more economically sensitive. They hold lower grade credit. Their fortunes are more closely tied to those of the stock market. You will have seen smaller companies do better. So smaller companies funds because they're more economically sensitive versus larger cap funds. But of course, we've seen some of that vaccine trade start to unwind slightly in the last couple of days. But like I say, it gives you a great stress test. Bookmark those dates. So when you're building your portfolio, you can just double check what's going to happen if this suddenly becomes a vaccine that's widely available. Now, the other thing I want you to do as a piece of homework is go to stockcharts.com/free charts/carpet.html. So that might seem odd, carpet, but basically they have a free tool that's called a magic carpet. And what it does, if you imagine a grid and lots of squares on the grid, each grid represents a sector, or you can flip it to be individual companies within the US stock market. And it works as a heat map. Green means that the stock price went up in that day or the period that you've picked for the analysis. Red means it's gone down. What it does is if you go there now and go and slide the slider back to the 6th to the 9th, you can see beautifully, hover over it, all of the sectors that did well on that day. So I'm going to tell you the best sectors were energy, real estate, financial, cyclicals and industrials. When the vaccine got announced, people thought, well, if the economy suddenly goes boom and it starts to expand, we open up the economy again, there'll be demand for things like oil and gas. Energy will be required. That was a big boost. Real estate. Look at all the empty offices that are out there at the moment. People aren't using. People will start wanting properties, particularly commercial property again. Financials, they are tied to the economy. Banks make more money when they're lending to a growing economy. When the economy is shrinking, then they don't make so much money because interest rates get cut. And obviously I've talked about cyclicals and industrials. Look at the other end when you do this analysis, you'll see consumer staples. So they're the things that you buy all the time regardless. So it'll be things maybe like toothpaste, that kind of stuff. Think Procter & Gamble, the stuff they tend to make, the things that aren't frivolous, the things you can't do without. Toilet rolls. People love toilet rolls in lockdown. Those stocks, they still went up, but marginally as a group, as a sector I'm talking about here, up sort of 0.29%. Well, we're talking about energy was up 17.6%, real estate was up 10%, financials up 9%. You can see this disparity. Healthcare was up 0.96%. Again, the up was because of the euphoria still from the US election, and people were still happy there was a vaccine, but you don't need to hold probably some certain healthcare stocks because they obviously won't do as well if there's a vaccine. I'll come on to a couple of examples. Technology stocks, like I said, did badly. Think about it. People aren't going to be buying stuff online at home anymore. They're going to do things offline. People are going to stop using things like Facebook as much, social media. They've been big beneficiaries in this lockdown. So communication sector only up 2% and utilities only up 2%. So go and have a look. It does have obviously a US bias, this tool, because there isn't an equivalent I can find for free for the FTSE 100, but you can see the same patterns reflected in the UK as you did in the US. You can flick to individual companies and see how they did. So ExxonMobil was up 12% on that particular day when the vaccine was announced because, as I said, people would want the demand for oil. In the cyclical sector, which actually includes Amazon was down 5% on a day. That's a big fall. And that was because there was two things going on for Amazon, actually. There was something going on with the European Union that I mentioned in midweek markets, but also because people were buying less online. Etsy, which is the online shopping site, down 17%. If you look in the UK, British Airways shares were up over 20%. Norwegian Cruise were up 26%, as was Royal Caribbean. Everybody thought we're going, or thinks we're going back to normal. Healthcare, yeah, of course, Pfizer was up 7%, but Biogen was down 28% because they were producing a treatment for COVID, not a vaccine, but a treatment. But if no one gets COVID, then you probably won't need a treatment if a vaccine comes along. And Facebook obviously fell 4%, 5%. So you can see there, this tool, coupled with what you saw happen on your portfolio and coupled with looking at tools like TrustNet, maybe Morningstar, whichever platform you have, if you can look at the performance over those 2 days, will be invaluable in telling you which funds are going to do well in a vaccine world, in a COVID-free world. And you might want to bear in mind that when you pick and diversify your portfolio, because if you're all bet on technology stocks, things could get a bit bumpy. But that's not saying rush out, change your portfolios. It's just pointing out that you can, if you're smart, you can make decisions that can help diversify the risks within your portfolio. And I did something of that myself this week on 80/20 Investor. And just before we finish on that piece, the other thing I would say is if you are looking at a fund and you like the look of it, then use something like Morningstar that is free. If you search the fund name and then you find the fund and scroll down, they have a funny little, like, almost looks like a grid, a Rubik's Cube face. Use that to show the blend of the fund, whether it's a value fund or a growth fund. And they tell you whether they're exposed to cyclicals or certain sectors. Using those tools, you can tell if a fund is going to be more likely, i.e. a value fund, to do better in an environment where there is no coronavirus. And also you can see whether they're exposed to small caps. You might want some more exposure to that. So what it means is you can be a little bit cute if you take this period. Although it was a bit of an upheaval, it's a brilliant example of using a very small period of time to be able to stress test your portfolio. Now, I must add one caveat. The pound did move quite a bit on that day because of news about Brexit. So that clouds the performance slightly because overseas funds would be a little bit more negative than they normally would because the pound strengthened. But if you're comparing performance within the same sector, so it's relative performance you're looking at, then that still is valid. So the message is, look what happened, learn from it, and then maybe that might be able to help you make a couple of bit more informed risk managed decisions in the future.
Interesting stuff. And actually, we're going to do a couple of investing pieces this week. Damien, you talked earlier in the podcast about receiving a question around percentages and how to compare them. Someone was a little confused as to returns on investments and how they're worked out. And I think you're going to read the question out, aren't you?
Yeah, I mean, this came from somebody within 80/20 Investor. And they started the question saying, look, apologies if this is a silly question, but they wanted to ask it. And you've got to realise in finance, there are no silly questions because people don't know anything unless they ask. I mean, it's the only way I learned anything, by questioning things. And then sometimes going to find the answers myself has spurred me on to go and try and understand things. And when we talked in the office, actually, Andy said, I think you should perhaps do this on a podcast. And others in the office said, well, yeah, I'm not sure it's as obvious as you think the answer probably is. Now, some people will find this a little bit obvious. It's maybe because it's about percentages. Others will find it a little bit more tricky. But we've got to make sure that everybody understands this stuff. So the question was that I talked about in my latest newsletter, which was last week, that my 50k portfolio hit an all-time profit of 41%, 42% since I started running it in March 2015. So obviously I was pleased with that. And they said, look, it worked out that was around about 7.2% growth a year. And he said, well, obviously, that's a pretty good annual return. But when you compare it to some of the other funds that had momentum that's been identified by 80/20 Investor, if you look at their returns over the last 6 months, then they were up about 22.7% for some of the higher risk funds, even up 35%. The medium risk ones were sort of 25% and the low risk ones were about 6%. And of course, when they look at that and then compare that to what was the annualized performance of my portfolio, they thought, well, which would they rather have? And the question was, well, is this a fair comparison, or were they doing a disservice to the numbers on my portfolio? Well, this was actually a very good question, because what they highlighted is the fact you can't compare percentages in a very simple way, two percentages where the time frames are different. Now, the reason is because a percentage is always, by its very nature, rooted into the starting point. And the starting point is a place in time. Like in my case, it was March 2015. So if you imagine a roller coaster that you're going along, and the roller coaster is going along and up and down, and then you get to a certain point and it stops, then a percentage growth will look at where you started and where you ended. And it won't take into account any of that journey that you've gone up and down. So in the case of roller coaster, you would have said, well, you didn't make any growth, zero, because you ended up where you started, like flat. But that doesn't account for the fact that you were up massively or down massively. The same with investing. So you can't compare a 6-month figure to a 5.5 year figure and say, well, look, this one looks better because of the 6 months it's done 20%. It's almost done half what you've done in just 6 months. And the reason you can't is because you have to look at what's come before. So whenever you see performance figures, just think, what has happened before? So what I did to answer this question, I took my portfolio and said, well, let's look at what my portfolio did over 6 months. And when I drew the charts, then my portfolio was up over 15% in just 6 months. And of course, that was because we had the coronavirus sell-off. We had markets fall 30% in a matter of days, weeks. And so we're taking measurements from the uptrend. So of course, it will look good. If you took some of those funds that might be up 30% and went back over a whole year, then the amount they'd be up, they might even be down. It'll be only marginal. So what you do is you need to compare the time frames with the same time frame. So if you're looking over 6 months, you need to pick the same 6 months. You have to be mindful of what came before. And to give you an example that's nothing to do with investing, if you take the news about the UK economy headlines this week, the UK economy bounced back 15.5% in the 3 months to September, the biggest rally or growth of the economy on record. Dig beneath the surface and it only expanded 1%, just over 1% in September, which showed it was slowing. But even though the economy had grown over 15% in the 3 months to September, it is still 8.2% smaller than it was before the coronavirus outbreak. So you're not comparing like the reason that it's had a big rebound is because it's had a big fall. The other thing is you might think, well, could you not just take the annualized return? So you could work out, well, if it's done this in 6 months, you annualize it up. What is the average over the period of time that you're looking at? Because that's one way of comparing things. You work out what's the typical return over a year. It's a mathematical calculation. The problem is if you take a small window, I like to think of things in extreme. It always makes things easier to understand. Always thinking crazy extreme examples. Let's say I bought a share and it went up like on Monday 20% because it happened to be a cruise company. If I didn't annualize that return, then given I earned over 20% in one day, I'd be having an incredible annualized return, despite the fact that the thing has fallen off a cliff in the last year. So annualizing really only works when you have a very long period of data and it's over the same sort of period that you're annualizing the returns. If you annualize returns during the crisis of 2008 and compare them over, say, 2017, when we had a great year, it's not the same. You're not comparing apples with apples. The other thing is I mentioned high risk, medium risk and low risk. With 80/20, we use a particular measure that designates what risk level a fund has. It's based upon how they make their money. And high risk funds will be by their nature high risk and be almost 100% equity. Medium risk will be mostly equity. Some will be a mixture of that and other assets. Low risk will likely be things like bonds. So you can't compare the performance of low risk funds directly with high risk funds, nor a portfolio like mine, which has only had about 48% equity content, particularly this year, with a fund that's 100% in equity. Because don't forget, generally speaking, the markets will move up. If the market moves up 10% and you're 100% equities, you're probably going to get most of that uptick, depending on what assets or particular sectors you hold. So if my portfolio was up 15% and it's only less than half in equities, a really crude, it isn't accurate rule of thumb is you could almost double that and say, well, what would I have got? Therefore, if I was 100% based in equities, it isn't quite right, but that would be pointing somewhere between 25-30% up, which, if you go back to what I said at the beginning of this particular segment, matches quite nicely those high risk momentum trades that I'd picked out with 80/20 Investor and the listener had highlighted. So the important thing is make sure you compare apples with apples. Understand that you have to pick the same time frame. The percentages are related to a particular starting point. And it is the reason why the FCA try and standardize the performance figures that appear on fund fact sheets, because in that way you are seeing a 1 month's return, say a 3 month, 2 year, 5 year, 1 year, whatever the periods, and it's up to the point of the fund fact sheet. So if you find a fund fact sheet for a particular fund at the same date, so at the end of say August, you can compare two funds in the same sector and look at how their returns have performed over a period of time and understand it and make an accurate comparison too. The other thing I like to point out, I'm a fan of Sharpe. So not Pat Sharp, but Sharpe, SHARPE, which is a measure of the risk you take and the return that's achieved with it. So if a manager has a high Sharpe figure, that means he has taken less risk and achieved more than somebody maybe in the same sector who has achieved a lower Sharpe figure. Think of it as two drivers driving around a racetrack, one driver going an absolutely nutty, losing the car almost on every corner, and he might get to the end a second before the guy who's just been much more sensible going round. The thing is, he may have got there quicker, but he had a very high chance of crashing out because he was being reckless. Repeat the race over a long period of time, eventually the guy will write his car off and he won't win the season. And so that's the analogy I like to use with Sharpe ratios, that you look at that. If you go to Trustnet and Morningstar, particularly Trustnet, they allow you to screen funds and look at their Sharpe ratios. So it's a very good measure to see, well, how much risk is this fund taking and how much return is it getting? So if the Sharpe ratio is higher, that's showing you that they're being risk managed really rather well. So it allows you to have a better comparison on the risk and the return. So there you go. A bit of a lesson on percentages and comparing apples with apples.
Good stuff. I thought that was a really relevant piece. Like I say, the more experienced investors and people who deal with numbers day in, day out may already get that. You may be preaching to the converted, but I think it's a really good explanation of how it works. I can see how people can easily get confused.
And it's not just about picking the highest number all the time when it comes to returns. That's one of the messages. And it was something we were talking to Lauren in the office, and she said, admittedly, she's new to investing. Yeah, I would just pick the highest number. And of course, the thing is, you've got to understand how, why, ask questions of what did the fund do to get there. And so what you'll see, these two pieces combined nicely get people to look under the bonnet of what's going on with the fund. And that makes you a smarter investor in the long run.
Brilliant. So just to finish off this week's podcast with a small piece on pet insurance. I've been looking at pet insurance over the last couple of weeks, and Lauren has been doing a great deal of work on the Money to the Masses website, putting a lot of really interesting content about how you can claim on pet insurance, which pet insurance is best, pet insurance for older pets, pre-existing conditions. It's all there. So go and take a look on the website. But I looked at all of that information on our website and I thought, do you know what? There's some key takeaways here for those that have got new pets and are considering pet insurance, or even those that have not bothered in the past. Maybe this might change your mind as to why. So just a few takeaways, really. First of all, I just wanted to focus on what pet insurance actually covers, because people don't always know exactly what you're covered for. It will generally cover you for your vet bills, any loss or theft of your pet, death, sometimes euthanasia, although that is extra on some policies, but sometimes you'll be able to cover death and euthanasia. Public liability insurance is often covered, and potentially any kennel or cattery fees are often included in policies.
So would that policy cover my cat licking people to death? Because my cat is obsessed with attacking people with affection. Does it cover that, Andy? Probably not.
Not specifically. No, not specifically, but you could probably look in the small print.
My cat is notorious for sitting outside my house and trying to befriend people. She's about 17. So this is interesting, this podcast. I mean, my cat, I'm veering off the money stuff here, but anyway, my cat has taken to, even though she's like 16, 17, she was a stray that we took in many years ago. She's taken to sleeping on top of my chest every night. I might share a picture of it on the socials if people don't mind seeing me asleep in bed. She's a crazy cat, but one of the things is pet insurance has been a real struggle, and that's partly because of her age and some of the conditions she's had. And so you doing this piece, there's things on pet insurance that I didn't know, and I don't think most people do. They might go for the cheapest. And one thing I want people to bear in mind, at the end of this piece, Andy's going to give you one tip that I didn't know, that you could be invalidating your pet insurance and you didn't even know. So I'll let Andy carry on. But one of the things, Andy, that I didn't know, I thought, yeah, cheapest is best. Does it cover most things? But actually, there's so many different types, isn't there, of policy that I didn't know.
There are indeed. So earlier, just then, I covered what is covered. Generally, what's not routinely covered, but you can sometimes get additional bolt-on bits, and this is where it gets sort of complex, is generally you're not covered for any routine care, such as vaccinations or worming, any birth or pregnancy complications, dental treatment, cover of pre-existing conditions, and obviously with older pets, sometimes you'll be refused cover as well. So try and get in early if you've got a pet and you're thinking about pet insurance. So just moving on now to the types of cover you can get. And you mentioned earlier about cheapest is sometimes best. With pet insurance, it almost certainly never is. And so you really need to dig under the bonnet and see what the type of cover is that you're getting quotes for. There are 4 main types of pet insurance quotes. The cheapest is going to be something called accident only cover. And that will generally only cover you for injuries sustained from an accident, say a car accident, if you've got a cat or something like that. It won't cover you for any illnesses, certainly not any chronic illnesses. So yeah, sure, go for that cover if you literally just want to be able to fix your pet if they get run over. But then moving up slightly in terms of the cost, you've got a time limited policy. This is where you will be able to claim pretty much for anything in terms of illness or injury, but on a limited period of time. So say if your pet suffers from cancer, it will cover you maybe for 12 months or 24 months, and then the policy will stop paying out and you'll have a difficult choice to make if you need to continue care after that. Moving slightly up the ladder again in terms of cost, there is something called maximum benefit insurance. Now, maximum benefit insurance is a type of pet insurance policy that gives an upper limit as to the amount you can claim on the policy. And once again, that will then stop. So for any chronic illnesses that your pets may suffer, you may find you've got a difficult decision once you reach that upper limit. The Rolls Royce of pet insurance policies are called lifetime cover policies. That's personally what I decided to choose, because I know that if my pet does have a long-term illness like diabetes or cancer, I know that the pet insurance will kick in and be able to cover them for the rest of their life. That's why it's called lifetime cover. There are 2 types of lifetime cover. Again, it's split into 2 different types. You've got an annual limit per condition policy or an annual lifetime limit lifetime cover. Sounds a bit confusing, but the annual limit per condition is slightly better cover, because what it does is it will say you're covered up to £10,000, £7,000, whatever you choose. You can choose the limit per condition per year. So actually, if your pet has complications and has many different conditions, you've got quite comprehensive coverage there. You then have another policy in the lifetime cover category, which is annual lifetime limit, which means that you have a total upper limit, let's say slightly larger than the 10k, say it's 30,000, but that's it then. Once you hit that upper limit, you're done. So crucially, the difference between the 2 is the annual limit per condition. Every year it resets and resets and resets. And so long as you pay your premiums, you're always going to guarantee to cover your pet. Obviously, the cost is an issue for some people. And that's where you can play around with excess. You can play around with cashback type policies that can bring that premium down.
I think you've explained that brilliantly, Andy, because I really didn't know a lot of this stuff. And we've been having conversations in the office. So you've just said which one you've got. I know we're not recommending to people what they have to buy, but given your research, which one did you have, Andy, of the latter 2 that you mentioned?
I had what I described as the Rolls Royce of cover. I've got the lifetime cover, and the annual limit resets each year per condition. It is slightly more expensive, but I decided actually to go for a cashback version of that policy. Now, interestingly, every different policy has a slightly different way of taking it. You can take a higher excess, lower excess. I took cashback purely because I'm paying a small percentage more each month for having that cashback policy. But crucially, if I don't claim, every 12 months, you get 25% of your annual premiums back as cashback.
That's quite an interesting idea. I never knew that. This is the thing. There's so many nuances. Andy's going to link to the different articles, because Lauren's even done analysis of the cost of the insurances for cats and dogs, hasn't she? And I think she even broke down some of it based on the pedigree of the animal as well. So there's a lot of nuances, but it does inform you, and it does actually make me realise the pet insurance I've got for my cat is pretty poor, to be honest. So I suppose to wrap that up, because this is a piece that is also inspired by the pandemic. Everyone's getting a pandemic puppy, and my kids are trying to get me to have one, but I'm not having a dog till poor old Bella passes on. There was one thing that came to light, wasn't there? I mean, obviously we talked about the benefits of the remote vets and things like that some of these policies have that are very, very good. So have a look at that, because it's worth using. Because if you're like my vet, every time I go within about 10 yards of my vet, I get charged about £500. I don't even feel like I have to walk in the door. I think he just got like a sensor to my bank account. I think he's got the world's biggest contactless pay station. You go anywhere near him and get money taken out. So using something like that saves you money, because like you did, you just had a consultation that was free. But the one tip that I didn't know, and I don't think many other people in the office knew, was around vaccinations, wasn't it?
Yeah, I mean, a key tip is to make sure that your pet is up to date with their vaccinations and various worming regime, because not doing so in some circumstances on some policies, it's worth claiming that, not all, it will actually invalidate the policy and will mean it doesn't pay out, especially if the claim can be directly attributed to a lack of vaccination or lack of worming. So yeah, just be careful on that. Obviously check your policy. Well, one, make sure your pet is up to date with their vaccinations, because you love your pet, don't you? And two, if you're not doing that, check your policies, because you don't want to be left with a big vet bill.
No, and the reason I know people might not necessarily do it is because people tend to do the vaccinations. Yeah, I know they don't want their pet to get sick, but a lot of the time it's so they can go into kennels or a cattery, because they insist on them having their vaccinations up to date. And so it can easily slip your mind. Given that we're in a COVID world where travelling isn't as prevalent as it used to be, perhaps there are people who think in this year they won't necessarily do the vaccinations, but you could be technically invalidating your pet insurance. I thought that was a good tip and something that's worth pointing out to people. So is that it, Andy? I think we've done everything now this week, haven't we?
We're all done. So if you want to get in touch with Damien, you can do so in the usual way. Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. Obviously, we're on Instagram, Facebook. Join our Facebook group if you can. Check out our YouTube channel and subscribe. And do please review the podcast. As we mentioned at the beginning of the podcast, we read out a couple of reviews. We'd like to do that every week. And reviewing the podcast helps us to spread the word, bumps us up the charts, and means we can help more people. That's it. I think we're done.
We are done. And if you've got any suggestions of what Andy can balance on his chin in our next group chat at work, then please do send them in. Usual address. So that is it. Until next week.
Until next week.